And for more on that now, I'm joined by Michelle Girard, Managing Director and US Chief Economist for Markets at RBS. Thank you so very much for taking time out and to be here with us on the big picture tonight. Well, clearly, as far as the CNBC survey goes, it clearly says that the prediction is that there's going to be a status quo. What are your own expectations from the US Fed meeting?
Yeah, no, we, like everybody, expects that the Fed is going to stand pat today, mostly because there has been no preparation of the markets for a potential move today. So for the Fed to act, it's not that they couldn't, but it would certainly be uncharacteristic for a Fed that has typically sort of set the stage and warmed the markets when moves, were under serious consideration. The data, though, I will say, do support I think the Fed continuing to set the stage for future rate hikes, if not today, then certainly in perhaps April or June.
Right. Since Janet Yellen went ahead and made that rate hike back in December, since then, we are talking about this impending slowdown in China. There's been an oil price collapse. Have all these factors are they now being increasingly taken into account, and has that made the Janet Yellen more cautious, you think?
Well, I certainly think it made the Fed more cautious in January, so much so that from saying the risks were balanced in the December FOMC statement, in January they drew no conclusions about whether or not the outlook, whether or not the risks were balanced still. And so you certainly saw more caution as the Fed moved to a wait-and-see mode, very obviously, in January. But we've come a long way even from January. We've seen, some of the concern over U.S. recession diminished because the economic data have continued to suggest the U.S. economy is holding up well. And importantly, we've seen financial market conditions ease. We've seen equity markets recover. We've seen oil prices rebound and inflation expectations rebound. So in many ways, we're actually back to underlying conditions similar now to how they were when the Fed hiked rates in December, and I think that probably has the Fed feeling much less cautious now than they did feel 6 to 8 weeks ago.
In fact, you actually preempted my question there, Michelle, because since the start of the year, the economic data that has been coming out of the U.S. seems strong, clearly pointing towards a recovery. But many say that this recovery is still very fragile, and a rate hike perhaps may jeopardize that. Do you sort of agree with these comments that are also coming in?
Well, I have to laugh. I mean, we're long past calling this a recovery in the sense that the economy has been expanding for over 6 years. I mean, we are almost long in the tooth, so to speak, of this economic expansion. And truthfully, to be seeing an economy that is still growing at a better than 2% pace at a time when, historically, the economy has already slipped back into a recession at this point in the cycle, I think suggests that the base for U.S. growth is more solid and less fragile than people expect. And I certainly do not think a 25 basis point increase in interest rates or 50, or even if the funds rate is ultimately raised to the 1% mark as we move through the year, that any of that would really throw the expansion into make it vulnerable or derail the expansion that we're enjoying at the moment.
Well, on that optimistic note then, Michelle, we're going to leave it at that. Thanks so very much for joining us here on The Big Picture. Let's now